The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
U.S. investors pressing pause on the tech rally with two overseas companies warning about the health of consumer and corporate spending. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. The stock market's rally takes a breather. It was on a record run, of course, with the S&P 500 and the Dow Jones Industrial Average retreating from their record highs. Chip makers like ASML and NVIDIA are among the biggest decliners today. Now, when you look at the KBW Bank Index, you've got 23 out of 24 names higher. Citi is the only decliner, even after its market division reported an unexpected gain in quarterly revenue. Now, when you look at treasuries, there is a rally taking place at the long end, so the yield on the 10-year comes down to 4.03%, and NYMEX crude plunging, taking NYMEX crude back to $70 a barrel on reports Israel may avoid trying to target Iran's crude oil infrastructure as well as nuclear infrastructure, which means the fundamentals, which is an oversupply potentially in 2025, returns to the focus.
All right, let's go back to stocks here, because prior to today, there really were a lot of people out there questioning that string of record highs, saying something had to crack and it had to crack soon. Even Bank of America strategist Michael Hartnett, in his latest note, said investors were way too bullish, with equity allocation surging, bond exposure sinking, two elements together that he says constitute a sell signal. Now, to be sure, Hartnett's note didn't actually tank the market. Let's be clear about that. But a surprise earnings warning from Dutch chip equipment maker ASML did. That company telling investors it booked only about half of the orders expected in the third quarter, and that was a huge shock to investors who have been in that deep embrace with chip stocks all year long amid AI demand euphoria. ASML ADRs right now down as much as 18% today, KLA down about 15%, ARM down 6%, and NVIDIA, the king, down about 5%. Meanwhile, the king of luxury goods, LVMH, not doing much better. Its ADRs plunging the most in 2.5 years as its fashion and leather sales, they fell for the first time since the pandemic. That once insatiable demand from Chinese consumers for Louis Vuitton shoes, Christian Dior clothes, for now at least, that's a thing of the past. ADRs of Gucci parent Kering also sliding here in the U.S. as well, as our U.S. luxury rivals, Scarlett, Ralph Lauren and Estee Lauder.
Yeah, and that's an intimate look at what's going on at the company level. But overall, global investors are super optimistic, according to the latest B of A Global Fund Managers survey. And that is showing up in their positioning on U.S. stocks. So take a look at this top panel here. It shows asset managers are now near record-long positioning on S&P 500 E-mini futures. The white line are futures contracts, and the yellow line represents 1 million contracts. This has happened around, let's say, 4 previous times since 2007. And in 3 of those instances, we've seen the market kind of take a little bit of a stumble in the subsequent days. You could see that in the circles. The question is, are we at that point once again? Romaine?
A lot of questions that need to be answered as we round out now into the final hour of trading here on this Tuesday afternoon. Lori Heinel is the Global Chief Investment Officer over at State Street Global Advisors, joining us now to kick us off to the close. And let's talk about investor sentiment right now. And I know one day doesn't necessarily constitute a change in that sentiment, but I am curious about how you feel about record levels right now for stocks, and the idea here that we're heading into an earnings season where there are a lot of concerns about the pace of earnings growth.
Well, we do believe that investors had gotten ahead of themselves. Certainly, as you know, there's a lot of uncertainty out there, uncertainty about the trajectory of the economy. And while we do forecast a soft landing, there's still a lot of bumps along the road. Concerns about the election, concerns about what's happening in other parts of the world, notably in Israel. So we've been actually surprised at how far and how fast this market has run, and we've started to take profits against that market run.
What pockets of the market right now, Lori, are you finding most attractive?
Yeah. Well, the first thing is we still are roughly neutral to slightly overweight equities. So while we've pared back our overweight position quite a lot, we still are slightly overweight, and we still do like large cap US. But the important thing is that we do see a broadening out of the market. So trying to take advantage of other parts like industrials, banking, other kind of cyclical sectors that perhaps were a bit left out of this rally that might have room to run from here.
You know, you mentioned how you're taking a bit of profits, and of course, Romaine talked about LVMH and the waning Chinese consumer. That, of course, all came out before China announced all these different measures to boost its economy. Do you think that's going to have a lasting effect on sentiment for global stocks?
We actually don't. And we're already seeing that China trade roll over even as we speak. And part of it is that there's just not been a lot of detail about specifically what kind of measures they're going to take. And oh, by the way, the size of the stimulus that they're talking about pales in comparison to what they've been able to deploy in past market cycles. So we actually don't think that there's going to be a lot of benefit as you look more broadly across the globe from any kind of China stimulus package.
And this is something that we're going to hear from multinationals throughout this earnings season as well. What's going to be the source of strength for companies when they do report earnings?
Well, there'll be a couple of things that we'll be looking for. And as you know, it'll be pretty idiosyncratic. Even within industries, those who have kind of cost leadership are going to be in a better position than those that perhaps are a little bit more price takers on the input side. So we'll be looking at things like, labor costs. How are those evolving through time? We'll be looking at things like, where are they seeing pockets of weakness or strength? We continue to like companies that have quality, that have strong balance sheets, that have competitive moats, and that are in sectors that are actually growing.
Is there any concern here, though, about some of the dynamics, particularly the dynamics going on outside the U.S. and its effect on the U.S.? Mike Wilson of Morgan Stanley this morning talking about the strength of the dollar, which is, of course, tied to the rate picture or the rate differential picture, and saying that could actually be, at least in his mind, one of the things that upends this rally.
Well, actually, one of the reasons why we've continued to favor U.S. large cap stocks in particular is because of that dollar strength. So you think about buying assets outside the U.S. and against that dollar strength, you're actually losing when you translate those, those currency translations. So we actually, in part, do like the U.S. because of the strength of the dollar. But it's hard to disaggregate right now what is really a kind of safety trade or a quality trade, which versus what's fundamental. So one would envisage that as the Fed sort of gets paced with other central policymakers, those interest rate differentials will be less a driver of the dollar, but there's still that flight to quality trade that you can't ignore.
I'm curious, when you look at the market today, Lori, and you go back over the years of your career, even in the early days here, are there any real parallels that you found, or are we kind of in completely uncharted waters? Because I feel like everyone's trying to sort of find that historical connection, and no one really seems to be able to give me that historical connection.
Well, we always say, history may not repeat, but it certainly does rhyme. And we've been in tightening cycles before, and we know that in tightening cycles, equities tend to run for a while, even after that first tightening, because you have momentum in the economy. And similarly, we've been in easing cycles before, and similarly, you see that in easing cycles, as long as there's no sort of undercurrent that we're going into a recessionary environment, that can be a reasonably good place for investors to be in equities as well. But what we do feel like right here and right now is that having a lot more diversification really matters, because trying to find specifically which pockets are going to outperform is going to be really, really tough, especially against a policy backdrop that's evolving.
So speaking of momentum, do you see any momentum in the oil market? Because it's being whipsawed by geopolitical developments. And of course, the undercurrent through all of this is that there's a lot of supply and demand, especially from China, isn't really shaping up to what a lot of people had expected.
Yeah, we were a little bit surprised that that oil was getting such a bid, because we just didn't see it in terms of the organic demand. And you have a lot of little calibrators. I mean, obviously you have what's going on in the Middle East, but you also have the ability of the U.S. to be an incremental source of supply in oil. So we were actually a little surprised when we saw the run up. So seeing oil correct a little bit here doesn't surprise us at all. We think it's going to be a pretty volatile trade just because of the geopolitical dynamics that underpin it in this moment, though.
We started with earnings. I want to come back to earnings. Will oil play a spoiler role in the third quarter results and the outlooks?
Well, look, the good news here is that, energy companies have actually trailed across the market this year. So there is sort of room for upside there. And again, given that we're likely to have a soft landing here in the U.S. and that the broader market globally is sort of muddling through, there will be demand. And so then the question is really, what's the cost structure? And again, that's where I think you'll see a lot of differentiation across the different earnings announcements.
All right, Lori, great stuff. Lori Heinel, Global Chief Investment Officer at State Street Global Advisors, kicking us off to the close with the S&P on the back foot, down around the lows of the day. But the one bright spot out there, you're going to find that in financials. The KBW Bank Index outperforming the broader market as the big banks delivered big results. A breakdown of those numbers and what it signals about the health of America's financial institutions.
Plus, we dig into the trends we're seeing in the fast casual dining space with Tracy Kim, CEO of the fast casual hotspot, Dig.
From banks to restaurants and, well, to airlines and trucking. We're going to get some more earnings later this evening out of United Airlines and J.B. Hunt. Full coverage of that a little bit later in the show. Stick around. A lot coming up. This is The Close on Bloomberg.
Shares of ASML plunging on a big bookings miss. The Dutch company behind the world's most advanced chip-making machines only booked about half the orders last quarter that analysts had expected, and also lowered its guidance for 2025. Let's bring in Mandeep Singh. He is senior technology analyst with Bloomberg Intelligence for more context here. And Mandeep, when we talk about chips, there's AI, which is, firing on all cylinders. NVIDIA can't make those AI chips fast enough. And then you have kind of everything else, chips that are used for the automotive sector and the industrial sector. What does that say about this bifurcation we're seeing in the chip industry?
I mean, in the case of ASML, and again, this was pre-announced one day before, so I think the headline booking numbers really was quite weak. But in the end, it comes down to, capacity expansion when it comes to the foundry side of the equation. And there are three dominant players when it comes to, companies making those CapEx investments for adding manufacturing capacity at TSMC, Samsung, and Intel. And we know TSMC has been executing really well, but not the other two. And that's where I think just based on that release that came out, it's obvious that the foundry CapEx side is the area that's pulling back. And I would say it's Intel and Samsung. Both of the companies seem to be pulling back, but that's not because the AI demand is weak. It's just these companies have their own idiosyncratic issues. Samsung announced a layoff. Intel, we know, has been struggling. So that sort of explains why that bookings number went down so dramatically.
So do you think, though, then this expansion of capacity that we've been witnessing, obviously overseas, but more importantly, potentially here in the U.S., that will continue?
I mean, look, we have the CHIPS Act here in the U.S., and Intel is one of the major kind of beneficiaries of that. And what the government was doing was really thinking long term in terms of, the foundry expansion that Intel could do with the CHIPS Act money. So it does put into question how that foundry ramp up will happen now that, there is an expectation that Intel may be pulling back on their CapEx. But look, this was just one quarter. Clearly, the bookings number is a big deal because it went down 50%. But I do think, there is a certain amount of seasonality when it comes to the semi-cap cycle. And that cycle could be different from how the NVIDIA chip demand may pan out. So there is a correlation, but that doesn't mean, it will all happen at the same time. And I think right now the implication that we can draw is clearly the supply expansion when it comes to the chip manufacturing side, especially from Samsung and Intel, would be more muted than what the market was expecting.
Mandeep, I got to ask you about something that former U.S. President Donald Trump said in his conversation with John Micklethwait at the Economic Club of Chicago. He was discussing his economic and trade policies, and of course, there's sanctions involved in there as well. Let's take a listen.
We're all about growth. We're going to bring companies back to our country. You look at even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs.
We're going to protect those companies with strong tariffs. And of course, that does include the all-important semiconductor industry as well. How thought through is the investor response to what we're likely going to get from a President Trump or President Harris when it comes to these sanctions on what chip makers can and can't do here in the U.S.?
I mean, look, there are already advanced chip restrictions when it comes to shipping chips to China. And I think even the Biden government has been quite vocal about manufacturing all the advanced chips onshore in the US, which is why the CHIPS Act came about. So there will be an extension of that. The challenge I see for companies in the US like Intel is they've been behind when it comes to chip manufacturing. Pat Gelsinger laid out the 5-node in 4 years plan, but it's hard to execute on it. And these things require a lot of upfront investment, and which is hard for a company like Intel, whose stock is under so much pressure. So maybe the government raises its subsidies. That could be one way, you encourage companies to do more in terms of investing upfront in technology. But other than that, I think it's hard to catch up in manufacturing, and that's what both Samsung and Intel are realizing when it comes to the advanced nodes relative to TSMC.
All right, Mandeep Singh over at Bloomberg Intelligence. Ship stocks remaining on the back foot here as we move closer to the closing bells. When we come back after the break, we're going to take a deeper dive into the latest batch of bank earnings. So far, so good. Solid results all around for Goldman Sachs, Bank of America, and Citi. A deeper discussion coming up in Top Calls right here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, the big movers on the back of analyst recommendations. And we start off today with Etsy. Goldman Sachs ditching its neutral rating on the online retailer with a downgrade to sell. The analyst over there, Eric Sheridan, saying he prefers companies with more subscription-based models like Amazon or those rooted in essential purchases like Chewy. A more discretionary company like Etsy, too exposed to the risk of inconsistent consumer spending patterns, according to the analysts. Investors say pish posh, pitching the shares up about 3% on the day. Advance Auto Parts up next, an upgrade today to outperform over at Wedbush. The analyst saying that since he's had some time to digest Carlyle Group's move to buy that Worldpac unit for $1.5 billion, he actually expects positive updates on the remaining core business when Advance Auto Parts reports third quarter results next month. The share is unchanged on the day, though. We want to end things, though, on Wells Fargo. Phillips Securities lifting its rating to accumulate. This after last week's earnings report and the analysts citing that boost from non-interest income, particularly from a recovery in investment banking fees and higher gains from trading activities. Those shares up about 2% on the day, and those are some of our top calls. But let's stick with that trading activity because it wasn't just Wells, it was Goldman, Bank of America, Citigroup, JP Morgan, all posting equities and fixed income trading revenue that surpassed analyst estimates by a mile. Citigroup, for some reason, though, sitting out of that rally. This after Jane Fraser had to react to a report on the company's earnings call about regulatory issues. Take a listen.
While we are not yet where we want to be, the impact of the changes we're making is clearly evident in our momentum and our improving performance. Turning to the macro, while growth is a notch slower than last year, global economic performance continues to be surprisingly resilient. Whatever you want to call the U.S. landing, the sentiment around it is more optimistic.
Jane Fraser, the CEO of Citigroup, speaking on that conference call a little bit earlier. One of the folks on that call was Jason Goldberg, Barclays senior analyst. He's got an equal on Citi and an overweight on Bank of America and Goldman. Let's start off with Citi because this seemed to be kind of a weird dynamic here. The results were certainly good on paper, but when they were kind of asked about that regulatory cloud, I don't know if it was the fact that either Fraser didn't articulate well enough what that regulatory cloud is, or investors have legitimate reason to be concerned.
No, listen, Citi's been operating under a consent order for several years now, and it just takes a long time to get through these consent orders, and they're trying to get through it. So it results in elevated expenses, relatively lower returns, and it's going to take them time to satisfy the regulators.
This isn't, though, a Wells Fargo type of story where we're going to see growth hamstrung for years and years and years, or is it?
No, I mean, you did see Elizabeth Warren a couple weeks back call on the OCC to, look to restrict Citi's growth. But as I sit here today, there's, nothing like that in place. They've absolutely made progress in terms of satisfying the regulators. If you look last July or earlier in July, they got a consent order a new consent order, but in that it did acknowledge they made some improvements in several areas. So they've made some progress. There's more needs to be done, but there's no limitations on what they can and can't do at the moment.
I want to ask about the trading revenue for the big banks. For Goldman, Bank of America, Citi, and JP Morgan, they all posted equities and fixed income trading hauls that beat analyst estimates for the quarter. In fact, it was the best third quarter on record. Given the volatility, what were you most surprised by within those results?
Yeah, you certainly saw, fairly strong results. At our mid-September conference, every one of those banks gave guidance, and they all, beat that guidance just 2 weeks later. So the quarter seemed to end, much stronger than expected. You had some kind of unwelcome volatility, which dampened August results, and you certainly saw improvement through the remainder of the quarter, which showed up, as banks reported late last week into early this week.
So how do you expect that to show up in Morgan Stanley's results? I think about how Morgan Stanley used to do so well on the equities trading, but has kind of given up that lead to Goldman Sachs over the last few years.
Yeah, no, certainly we'd expect what we saw, from the other big banks late last week and this week to carry over to Morgan Stanley tomorrow. So we would look to see them, outperform expectations of both trading results and investment banking fees, based on what we've seen so far.
Is the commentary that we heard from the various CEOs and CFOs, for that matter, on these conference calls, were you encouraged by that, Jason? And I mean more from that broader macro picture and whether that remains a bit of a tailwind for the results that maybe we get for the fourth quarter and beyond.
Yeah, I think that's a good point. I think one of the reasons, you've seen the stock strong, on Friday and again today, is just broader commentary around the economy, right? The consumer's holding up, I think, better than people maybe were concerned about. You did see unemployment spike up in August and, maybe kind of came back down the last couple of months, but the consumer's holding it well. You look at credit quality metrics, non-performing assets have been, surprisingly stable this quarter, and net charge-offs are actually lower with improvement in credit card losses across the board. So I think that's contributing to, the both stock price movement and overall sentiment.
Very quickly, Jason, when you look at the consumer, we talk about how the consumer is doing well, but certainly at the higher income level, at the middle income and the lower income, there's more selectivity, there's more pressure as well. Which banks are in the best position to profit off of that higher income consumer?
Yeah, listen, I think most of the bigger banks, concentrate on the middle to upper end consumer. Citigroup in its retail partners portfolio is kind of the lone big banks that's really kind of maybe overexposed to the lower end consumer. And you are seeing some pressure there, just given that cohort's most adversely impacted by elevated inflation and the like. But, broadly speaking, you've seen, the year-over change in credit card delinquencies continue to slow and losses, particularly this quarter, decline.
All right. Thanks so much. Jason Goldberg over at Barclays giving us his wrap of the earnings of the banks, the big banks that have reported. Thank you so much. And of course, we'll get Morgan Stanley coming up, still to come. But for the most part, it's been a bullish picture here for the big banks. All right. We'll get a check on how consumers are dining out and digging in at fast casual chains. Our conversations with Dig CEO Tracy Kim is next. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Scarlett Fu, and we have a little bit of a retreat from the record highs that we saw yesterday.
Yeah.
A lot of concern about the semiconductor industry and about the retail industry as well.
Yeah, well, really the chip stocks. I mean, that rattled a lot of folks. So let's face it, that's been the pillar of this rally all year long. And then when ASML comes out saying, oh, we only sold about half of what we thought we were going to book in the quarter, I understand why people are rattled by that. But then when we heard from Mandeep Singh a little bit earlier, he kind of talked about this idea that some of this is really idiosyncratic. It's not really somehow this data center AI trade has somehow become completely up.
Right. The data center AI trade is still very much intact.
Yeah,
but,
I'm building one myself.
You're building one yourself? Yeah, you and everyone else, right?
Yeah.
All right, let's talk about another part of the economy, which is the restaurant industry. Dining out in 2024 has taken on a whole new meaning, with more consumers opting for quick, quality meals. This so-called fast casual segment of restaurants is said to be valued at almost $125 billion globally. And North America holds the highest share by revenue. It's also one of the best performing parts of the broader restaurant industry, despite a slump in comparable sales for most of the year. That's why fast casual chains like Dig are trying to keep things new and exciting to keep consumers returning to its stores. I want to welcome now Tracy Kim, CEO of Dig, which is based in New York. Tracy, great to see you here.
Thank you. Thanks for having me.
So fast casual Capital occupies the middle ground between fast food and sit-down fancy pants restaurants. And I'm curious to hear how you are defining that middle ground when it comes to your menu options, your pricing, and your serving formats for those who haven't been to a DIG restaurant.
Yeah, let me just start. Thank you. Let me just start by describing what DIG is for those of us who don't know what it is. We are a fast casual chain based in New York, but we have 30 plus restaurants throughout the Northeast, from Boston, D.C. We're really American food, from our kitchen to yours. Everything is scratch made from very, very high quality ingredients, kind of an elevated version of what many people grew up eating. And so I think exactly what you said is right. The fast casual segment is really growing, sort of outpacing kind of other segments of the restaurant. And I think it's because people have just gotten busier. People have gotten busier, and people want the same high quality food that you would get in a sit down restaurant, but on their own terms, on their own time. They want to be able to pick up. Families have gotten crazier. Parenting has gotten harder. And so that's kind of where we are today. And I think why many fast casual restaurants are kind of doing what they're doing. And
your locations basically go from Boston to Washington, D.C., so it's like the Amtrak corridor right now.
Exactly.
You're in expansion mode as well.
Yeah.
With remote work and hybrid work still very much a thing, how much of that growth is going to be in the suburbs versus in urban centers?
Yeah, most of our growth has actually been mostly in the suburbs. Historically, our concept was primarily New York City urban based. So most of our restaurants, even to this day, are mostly Manhattan based. Looking at the growth over the past couple of years, it's been primarily in the outer markets, Boston, Philly, DC, as well as the suburbs of New York and the suburbs of DC, actually. So,
what's been the thought process, though, behind expanding your footprint here? 30 stores, it's a lot in one sense, but DIG's been around for a while now. I am curious as to what the strategy, what the corporate mindset is right now as to how you expand and the pace of that expansion.
Yeah, I mean, as you say, COVID changed a lot of consumer behavior, honestly. Remote working is really a thing. It's changed consumer behavior forever. I mean, I think that if we look at our sales patterns in the city, largely Tuesday through Thursday has returned back to sort of pre-COVID volumes. Monday is actually sort of increasing over time as offices sort of mandate workers to come into work. But Friday has been soft. I think it will always be soft. I think there's real flexibility around that fifth day of the week. And so for us, we're just trying to diversify our portfolio. We want to be where the mouths are, whether they're in the city working, whether they're in the city homing, or whether they're in the suburbs working or homing.
So I guess it gets to the idea of sort of who your customer is, or maybe who you want that customer to be.
Yeah, I mean, we think that our food is, well, we think it's very good. Hopefully you guys agree. And there's a lot of use cases for it, a lot of different occasions for it that we haven't historically tapped. Historically, we had very much tapped the office worker lunch, and there is a real use case for families of four who are looking for that last, 6 o'clock every night. I am asking myself, what am I going to feed my family? That is me. And so there's a lot of use cases, our food, and in many ways, our food is more appropriate for dinner than it is for lunch. So it's kind of ironic that we were known as sort of a lunch option. So that's been sort of the expansion strategy.
Is the menu offering the same then for lunch and for dinner, especially in your suburban locations where people are picking up food for the entire family?
It has been. I will say this fall was the first time that we're legitimately sort of from a marketing perspective double clicking on dinner. And so this fall is the first time that we have actually had dinner specials that are available only at dinner time. But many of our options are just available for lunch and dinner in different formats. As an example, we launched a DIG dinner bag, which does feed a group of four.
But how do you scale that? If you are expanding, right? I mean, there has to be some continuity, I would think, right? Or you want to keep the menu simple enough where if you go from 30 locations to whatever you want it to be, or does that not matter?
No, it definitely matters.
Okay.
I mean, I think the beautiful part of the menu is that it is essentially sort of bases, proteins, and sides. We mix and match a different format. For instance, we have, formats for groups of four versus individual bowls. And so it's the same food. It's just sort of, in some ways, mix and matchy. Yeah.
How much have you had to change your strategy because of GLP-1 and all those anti-obesity drugs?
We have, knock on wood, have not been affected by that dramatically. We haven't seen an effect on our business. I think there's still enough.
People still want carbs?
People still eat carbs. I mean, focaccia is something that we introduced last year and has been a very, very strong selling attachment. I think in our cases, many people are sort of looking for balance.
How are you testing, though, new products? I mean, there was a lot of discussion. We have a DIG right down the street from Bloomberg World Headquarters. There was a lot of discussion when that big placard went out on the street advertising these chicken sandwiches. And a lot of people was like, why is DIG in? Known for this bowl selling sandwiches. Now, I understand that a lot of the ingredients in that were kind of the same ingredients that go into the bowl. It's just kind of in a bun.
Yeah.
But is this idea, are you testing this out first, or are you just kind of throwing it out there and hoping that we like it?
There is some guesswork involved with sort of coming up with the ideas, but we're very test heavy before we launch anything fleet wide. We typically designate 1 or 2 restaurants to test new options. And either they perform well or they don't. And we've sort of shuttered a lot of test options that haven't performed well. The
are
chicken
you in the
sandwich.
test kitchen testing? What's your favorite meal there?
I mean, I like so many things.
Yeah.
I do love the crispy chicken myself, which was one of the new. It is baked, not fried, so it is still a healthier version on kind of a classic fried chicken. I do love the crispy chicken sandwich. I love anything with the crispy chicken, I have to admit. So,
there's a theme here.
Yes. I do love our Kale Caesar salad as well. So
I know you prioritize spending time in the field, talking to employees, talking to customers, working on the line to stay connected to your core business.
Yeah.
Home Depot CEO Ted Decker recently said it will require corporate employees to work a full day at one of its stores every quarter so that they can support their support staff, but also just to make sure that they don't lose that connection. Is that something you would mandate?
We are very rigorous about sort of our corporate staff being in the field. I mean, we always say it's one of our core values as a company that all the answers are in the field. Literally, every single answer is within the 4 walls of the restaurant. So we don't mandate it, but it is such a strong corporate value that it happens. It's almost as if it were mandated.
What is it like kind of running this company? I mean, I was looking at your background. I mean, you ran a tech app company for a few years.
Yep.
You're not really like a chef, kind of a chef owner kind of person.
Yeah.
Although I saw you were like a cookieista back in the day, like Mrs. Fields or something crazy.
Yes.
But I mean, was that a transition for you to be able to run effectively a restaurant chain?
100%. I mean, the difference between, I mean, my background is sort of half consumer and half growing and scaling businesses. This is a nice kind of combination of that. I will say the difference between a tech business or an app business and a 4-wall business, as you can imagine, is dramatic. In a 4-wall business, it's literally 100% about the people. And so the importance of being in the field and really connecting with the people and really sort of coaching the people is just paramount. I am out and about constantly because it's that important.
Do you think you'll ever expand to a point where you will have a sit-down part of the restaurant where people will come in, buy what they want, and then stay there and, possibly even get dessert afterwards at your restaurants?
It is not in the plan, meaning more like a full, more of a more service.
Fancy pants restaurant.
It is not in our plans currently. Our consumer, and I think consumers at large, I think the direction of consumers at large, at least for our segment, is really headed towards people who want the convenience. We have seating in all of our restaurants. Our suburban restaurants tend to be more spacious in terms of seating versus the one that you're referring to down the street here, which does have a second floor, but not that much seating. But that is not in the plans currently. It's tiny.
But then again, in fairness, the rents around here are probably astronomical.
Are astronomical. There is a second floor. Did you know there's a second floor at your restaurant?
I have, but I've never been there. I just kind of go in, I grab and go.
There is seating upstairs if you ever want.
Well, all right. Well, Tracy's showing us all the secrets here. Tracy Kim, as she would know, the CEO of the fast casual chain Dig. When we come back, we're going to take a closer look at the world of luxury real estate. LVMH out with earnings, and they were not good, largely missing analyst expectations in all of its major categories. A lot of concern about the world's second largest economy and the drag in the luxury space. It's our stock of the hour, and it's up next. This is The Close on Bloomberg. ADRs at LVMH falling today. This after the company said organic revenue at a key unit that includes the Louis Vuitton and Christian Dior brands declined 5% in the third quarter. Andrea Felstead is a Bloomberg opinion columnist who covers the luxury space for us. She joins us now on the phone from London. And maybe this wasn't a surprise to you, Andrea. I know you've been writing about this idea that some of these luxury goods makers were going to see a decline in their stock prices. What's ailing them?
It's really all about China. There seems to have been a real deterioration in demand from the Chinese consumer, whether that's at home or travelling abroad, between when they last updated in July and today.
Okay, so if the Chinese consumer is one that's struggling, and that's going to be the case, it's a structural issue there. How does LVMH, or for that matter, anyone in the luxury industry, replace the Chinese consumer?
I don't think you do replace the Chinese consumer. I think they've got to wait really for the Chinese consumer to come back. That being said, there are some things they can do. They can, reinvent their product ranges. Maybe got a bit stale. We've had a lot of quiet luxury over the last couple of years. That can be a bit dull. Develop some new products that excite people's interest again. It's not a surprise. We've had a lot of designer changes at these brands.
But on that point, Andrea, I just want to stop you there, because when we talk about the styling, I mean, LVMH obviously has got Pharrell there. You've got some new designers coming into some of the other houses that we just had on the screen there. And I just walked by the Balenciaga store down the street from Bloomberg World Headquarters, and they got a lot of crazy stuff in the window. So there's some creative things going on.
There are. They have to really excite consumers again, and they also have to reconnect with them through price. Now, LVMH was very insistent that it wasn't going to bring out lots of new lower price products to get them in. But I think at the edges, that is what they will do. There were lots of price increases.
Right.
You need to stretch the range up, but you also need to stretch it down so you've got something for everyone.
Andrea, thank you so much. Bloomberg Opinion's Andrea Felstead. We will be right back with more. This is The Close on Bloomberg.
We still are roughly neutral to slightly overweight equities. So while we've pared back our overweight position quite a lot, we still are slightly overweight, and we still do like large cap US. But the important thing is that we do see a broadening out of the market. So trying to take advantage of other parts like industrials, banking, other kind of cyclical sectors that perhaps were a bit left out of this rally that might have room to run from here.
Lori Heinel over at State Street Global Advisors. She kicked us off to the close just about 50 minutes ago, and kind of interesting saying she kind of pared down their allocation, at least in equities, to more neutral. She's kind of an outlier. A lot of folks are still overweight in this market, and we saw that reflected in the latest Bank of America hedge fund manager survey.
Absolutely. Overwhelmingly overweight in U.S. equities and less so in bonds and, more safe haven plays. When you look at the market today, it's very much earnings driven. And I start with the banks, right? Because you had Bank of America, Goldman Sachs, and Citi all reporting results that show they can really navigate this lower interest rate environment. But the bar is not high. No. So that might be part of it. Then you have chip makers, and ASML came out and really disappointed investors when it said it booked only half the orders that analysts had anticipated. But this just goes to show what the non-AI part of the semiconductor industry looks like.
And you always have to, I mean, you look at that 5% drop on the stocks, and of course it looks alarming. But then you have to look at the percentage gain that you've had over the last really 12 to 24 months in a lot of those chip names here. So this is less of a real sell-off as much as it maybe is just maybe some slight profit taking as people try to figure out what goes on.
Yeah, a little bit of right sizing. I also include Apple because it climbed to an intraday record high, and there were some bullish analyst notes out on the company before its earnings report on October 31st. And let's not forget energy stocks, which had been seeing a lot of support given all the Mideast conflict, and now down 3% because oil prices are dropping.
Kind of interesting, though, too, when we go back to Apple seeing that 1% gain, because just yesterday everybody was talking about that today or maybe this week would be the week that NVIDIA actually surpassed Apple in market cap. So interesting to see NVIDIA on the day down about 4 to 5% and Apple actually gaining here on the day. Of course, a lot could change over the next few days or weeks as we move closer to the closing bells here on this Tuesday afternoon. Joining us right now is Leo Kelly, founder and CEO with Verdence Capital Advisors, counting us down to the closing bell. Leo, great to have you back here on the program. And I want to start off with kind of this rally that we've had. I don't know how you spent your weekend, but some of us were popping the champagne corks for the 2-year anniversary of this bull market. I'm not sure much has changed in terms of investor sentiment and, more importantly, the fundamentals that have supported this rally. But as we head into year 3 of this rally, of this bull market here, do you find any cracks at all that we should be worried about?
Well, there's absolutely cracks you should be worried about. Mostly, first of all, the bull market is aging. And by the way, that's good. I think this entire market cycle started in really January of 22, right? This is the inflation bear and the recovery. So we're coming out of it. The bull market is finally really taken hold, and we're starting to get positive overall returns since January of 22. Inflation has slowed. But there's plenty of signals here that I think you have to be concerned about. One is this has been going straight up for some time, and there's a segment of the market whose valuations are starting to get quite high. So there's a real bifurcation in value in the market, and that's something to take note of. From an economy standpoint, we still have weak manufacturing numbers. We still have a tired consumer, while some of the more recent numbers are okay. We still see massive run-up in credit card debt, some defaults at the lower levels of credit. So this is really, it's the kind of thing where you can find something to root for if you're a bear or a bull. I think you just have to be pragmatic here.
Well, how do you allocate in this environment? We were speaking with Lori Heinel earlier. She talks about how she went from overweight to neutral on her equity allocation, despite the fact that a lot of data shows out there that the vast majority of institutional investors right now are still overweight U.S. equities.
Yeah, and I'll tell you, Romaine, I get nervous when people are rooting for outcomes, right? When they stop analyzing and they start rooting. And we're seeing a lot of that, right? You've got a massive overweight to equities. Historically, if you look at that, that usually is the harbinger for maybe more volatility in the market at the very least. I think you also have to take a look at the current situation with the Fed. Everybody got real excited last year about 6 rate cuts, and that just didn't happen. The Fed now comes with a 50 basis point cut. You have to ask the question, with asset prices at an all-time high, with unemployment numbers still pretty good, and GDP growing, why 50? And so that's something you have to take a step back. The market continues to want this free money, low interest rate environment that ran up money supply by 40% in 2 years that we're just now starting to get our hands around. So the answer is, how do you allocate? I still think inflation is a major threat, that if the Fed goes too soft early, we'll see inflation come back very quickly. So I think you have to stay away from long bonds. You can still allocate to equity. We are actually we're right around neutral weighting ourselves. But what we've been doing is we've been moving away from the high price growth areas and going where there's value. International developed as 2 standard deviations away from its normal valuation.
So you talk about how all the rooting is a concern. In terms of the most overcrowded trades, according to Bank of America, long Mag 7, long gold, and long Chinese stocks. Which of those trades is most vulnerable to a steep pullback?
Long Mag 7. So you've seen the valuations go up like crazy, and everybody is talking about them as if they're inevitable. The earnings growth is inevitable. AI is inevitable. But historically, what we find in these major generational changes, like the internet, like mobile, like social, like the TV, railroads, you name it, the infrastructure side of that buildup usually is met with high multiples and a lot of excitement and enthusiasm. That has to moderate, and then you come into the next wave, which is the actual application of the generational change. I think we're getting towards the long end of the infrastructure build of AI, and we have to start looking forward. So AI's got decades of build out to go.
Sure.
So it's not necessarily that AI is not going to work. But we're starting to get some really high valuations, and I think those valuations are starting to get ahead of itself.
So, Leo,
gold is what gold is. It's going to be volatile around inflation numbers.
So, Leo, when Netflix begins reporting earnings on Thursday and kind of kicks things off for the big tech companies, I'm wondering, what is the question that investors are going to want these tech companies to answer for them to get another leg up, given all that you've said about expectations have kind of gotten ahead of themselves?
Well, you just hit it on the head. What is the expectations for these stocks are so big that what they're going to want is continued upside surprises to estimates that have already been raised based on prior outside surprises. And so this is what happens. The expectation gets so overwhelmingly high that barring another phenomenal growth story like the beginning of AI, it's going to be hard to continue to just keep beating these growth. This is a time, you asked how to invest, this is a time for investors to use common sense. Keep your allocations tight. If you have big profits in overweighted areas because of the run-up, that's great. Hey, Leo, but you got to keep paring down and put it where it's
Leo,
cheap.
We're going to have to leave it there. We're up against a hard break. Leo Kelly over at Verdence Capital Advisors, counting us down to the close.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic with Scarlet Fu taking you through the closing bell, a global simulcast. It starts right now. Carol Master and Tim Stenovic joining us from the radio booth. Alex Steele is off today. We welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Quite a turnaround, Carol, from what we saw yesterday when more than 400 S&P stocks helped to lift this market to another record high. All of those gains given back today.
Yeah, no records today, that's for sure. It is kind of a mixed bag, though, if you look at the S&P 500. But something I'm assuming you guys have been talking a lot about, we have too, is what, Tim, is going on in the semiconductor space.
Yeah, we're seeing the stocks down right now more than 5%. The biggest decline going back a couple of months. A big part of that has to do with what ASML said a little earlier in the session today, sort of early releasing those numbers that they were set to release tomorrow and kind of sending some chills across the industry.
Some chills, given that investors are way extended when it comes to equities, right? Global investor optimism posting its biggest increase since June of 2020, according to the latest Bank of America Global Fund Manager survey.
Yeah, and we talk about this idea of like where the allocations go next here. Is this going to be predicated on the back of the support from earnings, and the earnings that, let's face it, are still projected to be relatively good, at least on a percentage growth basis. Now, the idea is that whether that commentary going forward for the fourth quarter in 2025 disappoints. But so far, I know it's still incredibly early, but so far, so good. We get the closing bells here in New York. Let's walk you through the numbers. Pretty much a similar story to what we saw yesterday, but just kind of the flip side of that. With red across the screen, similar declines across the board, with the Dow Jones Industrial Average lower by more than 300 points, or about 0.8%. The S&P 500 also down roughly about 7 to 0.8%, while the NASDAQ Composite is going to close out the day down 1%. The NASDAQ 100 down 1.4. And we did see a little bit of strength for a good portion of the day in the mid caps and in the Russell 2000, but that faded as we got closer to the closing bells. The Russell 2000, we're just going to call it unchanged on the day. Green on the screen, if you will, Carol Master, but only by about 1 point.
Yeah, but definitely a bit of a not performer there compared with some of the larger cap indices. Having said that, the S&P 500, Romaine, kind of an even split, 244 names to the upside, and you've got 258 to the downside. And it's earnings season, and you've got United crossing the Bloomberg.
All right, United Airlines third quarter adjusted EPS comes in above estimates at $3.33. Estimates were for $3.07. The United third quarter available seat miles coming in just above estimates at 81.54 billion. Operating revenue coming in at $14.84 billion above the $14.72 billion. Shares, though, right now down by about 1.3%.
And I'm also looking at the forecast for this quarter. Fourth quarter adjusted EPS will be anywhere from $2.50 to $3. The consensus estimate is smack right in the middle of $2.75. United also sees full year adjusted CapEx, its capital expenditures, below $6.5 billion. Analysts were looking for somewhere in the neighborhood of $6.33 billion. And United says that it will initiate a $1.5 billion stock buyback program. That is the first since 2020.
All right, we're also getting some results out of Interactive Brokers. Total net interest income, the main metric people pay attention to, up about 9% year over year, though that is slightly below street estimates. They were looking for about $823 million. They gave them about $802 on the nose here. Adjusted EPS also missing $1.75 versus a street estimate of $1.82, and top line revenue for the most recent quarter. We'll call it in line, $1.33 billion. Street was looking for $1.34 here. Total customer accounts right now in line with estimates at 3.12 million.
Yeah, and this stock's been on a tear this year. It's up more than 85%. It hit an all-time high in today's session. You're seeing that stock down about 4%. Digging a little bit deeper, you've got average customer credit balances up 12% year over year. Average customer margin loans, they are up about 28% year over year. So a little bit more in terms of what they're seeing on their platform.
All right, I'm watching what's going on over at United. The company did report a third quarter profit that came ahead of Wall Street's estimates, a sign that the company is bouncing back from those fare discounts that squeezed many carriers over the summer. To rehash some of these numbers, the share's down 0.8% as we speak. Adjusted profit, though, came in at $3.33 a share. United said, topping the $3.07 average analyst estimates compiled by Bloomberg. Also, as Scarlett said, that new $1.5 billion share buyback, including as much as $500 million just this year.
Kind of interesting. They're calling this their busiest third quarter, at least when you measure it by passenger volumes and the revenue associated with that. They talk a lot in this earnings release, which I think is interesting, about the so-called customer experience and some of the things that they're trying to do, I guess, to make things a little bit better, not necessarily on the plane, but actually at the airport and in their lounges themselves. Lounges, I should point out, that have a lot of work to do. Just saying.
Go on.
Remains a little bitter that he can't get into the lounges. We've talked about this. Yeah. It's only if you have the credit card, the co-branded credit cards, because
I don't know. You need like the secret knock, the secret handshake. I don't know. I don't know who I got to pay.
It's gotten a little crazy about who they let in, right? Whether it's the credit card, whether it's a certain kind of flight, it gets a little nutty.
Yeah, absolutely.
Or maybe they just don't want you, Romain.
Pretty much. I think that's it.
I think they want to create different experiences for people, and everyone's trying to chase a premium passenger. I mean, Delta has really done a good job with that, and everyone else is trying to do the same. And the discount carriers are the ones kind of left battling it out. And we've seen what's happened with Frontier, with Spirit, with Southwest, for that matter.
So they opened the Reset Suite by Therabody. I got one of those little Theraguns now. So maybe does that get me in? Do I just show the Theragun? This is
I don't even know what you're talking about.
Yeah. I mean, Tim, what are you talking about? I know you probably spend all day in the Therabody.
No.
Go ahead.
I don't get to spend any time at that part of the airport. That's the problem.
Oh, okay. What are you flying? Private or what? What's happening? Okay. Well, anyway, when we go back to the earnings and this idea here, in all seriousness, we talk about this sort of that uptick in passenger revenue. And we saw something similar out of the results that we got last week. We see it today in United, and we'll see if that carries over to some of the other airlines. Certainly with American, God only knows what the heck's going on with Southwest and JetBlue.
I will say that Barclays, let me get it out there, raised its price target on United Airlines just yesterday to 66 from 60. So we did see the stock close at 64 in today's session. Noting that results could beat forecasts given lower fuel prices. This is coming from the fly. So we are seeing, we'll look for some commentary on that. Another one crossing.
Okay, just looking up JB Hunt right now on the Bloomberg terminal shares in the after hours right now. Just pulling it up. Excuse me. Shares in the after hours right now are higher after the company reported results, up by more than 4.2%. The company reporting. Just pulling it up here. Sorry, guys, a little slow. Third quarter revenue that came in at $3.07 billion, beating estimates of $3.01 billion. Third quarter EPS coming in at $1.49. Estimates were for $1.39. Shares higher in the after hours.
Yeah, intermodal revenue, $1.56 billion, beating the consensus estimate, and dedicated revenue, $846 million. Trailing the consensus estimate of $857 million. Keep in mind, this is a stock that's down about 11% this year.
I see you're very broken up by this.
I am.
Scarlett. Absolutely. But it gets to the question too. I always love looking at these because you kind of get a better sense.
Are you taking care of your co-host?
No, but we get a better sense of kind of this idea of kind of where economic activity is. Obviously, you get a taste of that with the trucking companies, and I thought it was interesting because we came into today and there were a couple of reports by the National Retail Federation and a couple others about some concerns that holiday spending might be a little bit lighter than what it was last year. And so you start to think about where the goods are, what we're buying, and of course we had those results out of luxury handbag maker LVMH not doing good. Of course, that's more of a China story, but the question is how does that feed back into the U.S. economy?
Yeah, I mean, the big question is what JB Hunt says about the current quarter and the outlook given the upcoming seasonal shopping period and what retailers are doing in terms of their ordering. Some people will say that they're done with the destocking inventories, but then we also know that a lot of them had overstocked because of anticipation that there would be a port strike. We did get that for 3 days, and if it had continued, it would have been a benefit to JB Hunt, but it so far has been resolved, or at least they're no longer striking. And it may be resolved soon.
Hey, just go back to United, United, which is up in the aftermarket, up about 1.6%. I'm looking at Delta; it's up about 0.6%. Americans up about 0.7%. JetBlue, meantime, just up about a fraction, about 0.1%. But again, we continue to see United gaining some ground here.
What's your favorite airline, Carol Massar?
She loves them all.
I love getting on airplanes. I just think it's like the coolest. I absolutely love. I love going places. I love it. I don't know.
I can tell you which one's my favorite.
I like a clean one. That's what I like.
Yes. You're not brand specific in that way, then.
No.
Mine is the least expensive one where I'm still allowed to bring a bag.
No, can I tell you, Tim, when
I don't think those exist anymore.
when we are flying somewhere, he like checks to see what we're going to be flying. Like we go through this whole process.
Well, whether it's Airbus or Boeing, you mean?
Yes.
You gotta see.
Oh, you're one of those guys.
You got to see what kind of seat you're going to have.
Want to know if they're a new plane?
That's all right. I did this. In fairness, I did the same thing. I booked a flight this morning, and they gave me two options. One was like on some tiny Embraer jet, and the other was like a Boeing 7 whatever. I was like, I'm going to take the bigger plane.
I should have done that because I flew back this morning on a red eye from California. I ended up in the area right ahead of the bulkhead where I couldn't recline my seat. So on a red eye flight and not able to recline, it was horrible.
So what'd you do? You just stared
I thought about it the whole time how I needed to sleep.
Scarlett.
Did you just stare at the back of your seat like David Putty for the whole flight and just, okay.
Finley,
I'm just impressed
it's like herding cats today.
Even
I'm just
here
telling
today
you.
after a red eye from the West Coast.
We have no producers today.
Yes,
we run the show.
All right, we're closing the mics, everybody. That's a wrap. Our cross-platform on radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow.
A lot more coverage coming up here on Bloomberg Television, a deeper dive into those earnings that we just got out of United Airlines. Nicolas Owens going to be joining us in just a second. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A down day in markets, a complete reversal of what we saw yesterday. 0.8% gain on the S&P 500 yesterday to a record high, giving back all of that today. 58.15 and change is where the S&P 500 settled. And really, a lot of the news today had nothing to do with what's going on specifically here in the U.S. Some warnings out of ASML, some warnings out of LVMH, really hitting investor sentiment here on this Tuesday afternoon. Of course, that could turn around in a big way as we get deeper into this earnings season.
All right, speaking of earnings season, let's go through a couple of movers in regular trading. United Health falling the most in 4 years. Its full year forecast for this year and next year trailed analyst estimates because of rising medical expenses and stricter federal reimbursement rules that are eating into revenue. That stock down 8%. Schwab up 6%, seems to be recovering, moving past from its 2023 turbulence after its EPS topped Wall Street estimates and Schwab curbed some of its expensive debt. Wolf Speed, ticker is Wolf, the maker of chip devices used mainly in EVs, is in line to win $750 million in U.S. government grants and the same amount in financing led by Apollo to support its factory expansion plans. Now, after the market closed, we also heard from J.B. Hunt, Interactive Brokers, and United. J.B. Hunt gaining after third quarter EPS beat analyst estimates. You can see IBKR dropping after third quarter adjusted EPS miss along with revenue, kind of a contrast to the big banks and what they said about trading revenue. And United Airlines finishing higher in after-hours trading, third quarter adjusted EPS, beating estimates and announcing a $1.5 billion buyback program.
Absolutely. Here, $3.33 on an adjusted basis on that EPS on top of $14.84 billion in revenue and, more importantly, guidance going forward that investors seem to like. Nicolas Owens joining us right now, analyst over at Morningstar Research Services. And overall, it looked like a relatively clean report, Nicolas. Was this what you were expecting?
By and large, yes. I mean, there's a few variances with some of the revenue numbers based on what I saw in my third quarter expectations, but it was a good quarter, and they kind of signaled that they were going to do well with the industry slowing its capacity growth.
It's kind of interesting. Some of the commentary that we saw in the press release, and I know we're still waiting on the conference call, they spent a lot of time, a lot of real estate in that press release talking about the customer experience, updating kiosks, making the check-in experience better, new lounges at this airport and that airport here. I don't remember seeing that to this extent in past releases. Why are they highlighting that?
I think two reasons. It's competitive, so there are more and more, I would say, competing with Delta, and both of those are pulling away, in my view, from American in terms of their ability with the planes they have and the seating arrangements they have to really go after segmenting premium customers. And at the end of the day, if folks have money to spend on travel and can get from A to B on more than one airline, they're going to make choices based on these sorts of things. Where am I going to be waiting my extra hour here, or is it a comfortable experience? And I will note that updating lounges in your top 10 airports costs money. So we'll see how that shakes out.
Yeah, absolutely. United says it still sees full-year adjusted capex in the neighborhood of just under $6.5 billion. Analysts were looking for about $6.33 billion. You compared United with Delta. Delta is seen increasing, or says it'll increase its fourth quarter capacity by up to 4%. What are you anticipating for United in terms of its capacity increase, and what specific markets would that allow it to move into?
I don't have a forecast for 4Q capacity per se. I mean, my guess is it'll probably be very similar. I think one of my takeaways, and in general the way I view the industry, is that they're very interdependent, right? So United's pulling a good quarter here, partly because other airlines cut back capacity as well as United. And so as long as they're kind of following a similar script and following similar market signals, it'll work out. I think they're all benefiting from slightly lower fuel costs here throughout than anticipated, which allows them to lower prices without eating into profits, and that can stimulate demand. But so they're, my guess is, I mean, they are tempering their capacity growth compared to what they thought they would be doing a year ago, but that's for the health of the industry, really.
There's a lot of questions, too, about whether it will add routes to its international destinations. It still, of course, has suspended flights to and from Tel Aviv indefinitely because of the conflict taking place there. How big a contribution are these international routes to its bottom line?
Pretty big. I mean, all of these big legacy carriers have meaningful international franchises, and some of those are some of their best routes. And they're in an environment where they're, let's say, cutting back capacity growth. They can be picky. It's also an environment where there's still short planes and air traffic controllers and pilots, and so they can, in a way, benefit from those constraints and put their capacity where it has the best return versus chasing sort of mediocre on a competitive route that in a more, let's say, permissive capacity environment.
So when we look at the airlines, the major U.S. airlines, that is there a way to differentiate? I mean, and I'm speaking more from the investor perspective, because we always talk about these airlines in a very homogenous way. And I understand the industry is what it is between regulation and pricing and everything else here. It's hard to kind of separate yourself from your competitor here. Is there a way to do that, or is this just the world they live in?
I think there is. You could say there's a little bit of I think barbell is the phrase people use in terms of, let's say, Delta and United in the U.S. for sure, and to some degree Air Canada in this North American market, being able to offer differentiated or at least premium things like lounges and seats and the way they package and unbundle pricing for cabins and so forth. And it's a little bit of circular logic when they say, 50% of our revenue came from premium seatings. Well, that's because that's the stuff you charge the most for, even though it's a minority of seats. Then the other side of the coin, which you've seen Southwest suffer from, and you mentioned, I think, Frontier earlier, is what I think of as the back half of the plane. It's been interesting to watch these legacy carriers like United. They're able to sell the back half of the plane at competitive rates to a Southwest. And that's been a price war here in the last couple of months and hasn't been pretty. Yeah. Of course, if you're United or Delta, you're happy you have the front half of the plane to essentially, make money on. Yeah. But in that respect, it's ironic because American had the newest fleet for a while, but it is not as configured for segmentation as United's and Delta's. And that's why I think these two are pulling away a little bit in this, call it premium experience or travel experience segmentation exercise. It used to be defined as business versus leisure, but those are the same people. And so now it's really just money to spend versus not.
Nicolas Owens, very well put, industrials equity analyst over at Morningstar Research Services. People with money to spend, people who probably have been miserable on a flight in the back of the plane for too long are like, you know what, I'm going to use some of my miles or use some of my credit card points and pay for a little bit more legroom.
Yeah, but they got to be consistent with that too, right? I mean, that's the problem. It's like sometimes you pay for these upgrades or these extra add-ons, and then you kind of, when you get off the plane, you're kind of like, was that really worth the extra money?
It's because
I know for you, you need a seat that goes back. I don't know, maybe you had to pay an extra $30 for that or something.
If I was on Ryanair, I probably would have, right?
Right. Well, I'm sure they're probably coming up with a way, like a little app here, just
exactly. Unlock the seat recline. All right, coming up, we're going to stick with earnings. We're going to break down J.B. Hunt's results next. The stock currently up 7.5% in after-hours trade. This is The Close on Bloomberg.
Earnings season is here.
I think that this earnings season is going to be so important.
Bloomberg is first to break the numbers.
NVIDIA earnings now crossing the wire.
Bank of America, the retailer Five Below.
There is something for everybody.
With the smartest insights.
Weaker inflation is not great for earnings.
I think the consumer's a bit more resilient.
You've had earnings recessions flow through growth and then cyclicals and defensives.
Earnings cycle continues on Wall Street.
Continuing coverage on Bloomberg. Context changes everything.
We're looking at shares of J.B. Hunt, the trucker, gaining in after-hours trading after the transportation and logistics company reported results. Third quarter adjusted EPS and revenue both topping analyst estimates. The stock climbing 8% in after-hours trade. Lee Klaskow, who covers transportation, logistics, and shipping for Bloomberg Intelligence, joins us now. Lee, at first blush, was there any weak spot within this earnings report?
The final mile business, which is their smallest business, came in a little below expectations, but I think we can really overlook that. All of its other major segments have kind of beat expectations, and I think that's just telling us and reinforcing our thesis that the worst is over for the freight market, and we're setting up a pretty good fourth quarter in 2025.
The worst is over for the freight market. Does that mean that expectations have come down sufficiently, or we're at a point where we're going to see growth and we're kind of primed for that given what the stock has done?
We've been relatively bullish when it comes to trucking and railroads, and kind of J.B. Hunt is at that crossroad, but their intermodal business. Its intermodal business saw some really strong growth, which was, I believe, 400 basis points above expectations on the volume side, and that the growth was not only in their transcontinental business, so stuff coming from the West Coast to the East Coast, but it was also its Eastern network, which is more truck competitive. So that's telling us that the intermodal is back. Intermodal suffered for a while because of really poor service from the rails. The rails have done a much better job at improving service. That coupled with spot rates in the trucking market, which are slowly moving higher, makes intermodal a lot more attractive to shippers because it's much cheaper.
I'm curious, how did we get here, though, Lee? Did that sort of happen, just the natural sort of evolution of the industry, meaning getting us back to some sort of sense of normalization when it comes to spot rates and capacity? Or is that more a function of some of the companies that went out of business and some of the consolidation that we saw?
Well, I think the market has been overly pessimistic about where we are in the freight cycle. We've kind of, our thought is that, we're going into the fourth quarter. We are going to see a seasonal uptick. It's not going to be a robust peak season, but it's going to be a modest peak season. You have that coupled with what's going on in terms of freight demand looking into the fourth quarter. I know we're talking about third quarter, but looking into the fourth quarter, you had two major storms, which will have some rebuilding and relief efforts. So a lot of freight demand going into those areas. And then you have the kind of the dislocation created by the port strikes in the East Coast and Gulf Coast, which the ports are backed up for about 2 or 3 weeks, and trucking is key to get those backups back to normal. So net really good, or maybe not really good. That's maybe a little overly optimistic, but a much more better freight backdrop. And I think those expectations were really low going into the third quarter because there was just a lot of unknowns, and I think that it appears that J.B. Hunt is not only benefiting from the backdrop, but they're also benefiting from their own productivity improvements that they're doing in-house.
So obviously they just certainly deserve some credit to that. But if this is more of an industry-wide or economic-wide tailwind, if you will, when we start to get results out of Schneider and Werner and Knight Swift and some of these other trucking companies, are we going to see similar positive results?
I think we should differentiate between positive results or less negative results. I think you're going to see less negative results, and some CEOs have a little more optimistic tone when they're talking about, where they see rates. We believe that rates are going to increase by low to mid single digits on the contractual side for truckload next year, and that should really cascade into all markets. So that should benefit intermodal, should benefit railroads, parcel, air freight.
Lee, great to have you. Lee Klaskow, who covers transportation, logistics, and shipping over at Bloomberg Intelligence. A deeper dive into those results that we just got out of J.B. Hunt. Those shares up 8% right now in the after-hours trade, which is pretty big for this company.
Well, it makes sense given how much the stock has fallen this year. It's down 11% in a market that's largely up. And since the last earnings report, up 1.7%. So there's a lot of people waiting around to get that confirmation that perhaps we've reached an inflection point.
Yeah, and it gets to the question, too, as to whether we are back to some sort of a normalization of this industry, an industry that really kind of got kicked into the teeth, largely because of its own sort of excesses, if you will, here in terms of capacity and everything else. When we come back after the break, the close continues, where we could take a trip down to Mexico City, where Bloomberg's annual City Lab event is underway. We're actually going to hear from the mayor of Oklahoma City about how his city is rebuilding its infrastructure. That's coming up after the break, right here on The Close on Bloomberg. All right, welcome back. It's time now for our Muni Moment, and we're going to talk about Oklahoma City. Because that city is once again hoping to use general obligation bonds to fund infrastructure projects, something it last did back in 2017. Now, these types of bonds are usually issued by state and local governments and backed by the full faith and credit of the issuer. And historically, they've provided the lowest borrowing costs among long-term bonds. They currently make up about 28% of the muni market right now. Pleased to say joining us for our Muni Moment is the mayor of Oklahoma City, David Holt, who is not in Oklahoma. He's actually down in Mexico City, where the annual Bloomberg City Lab Summit is taking place. And Mr. Mayor, we're going to get to the City Lab event in just a second, but I do want to ask you about this potential sale of general obligation bonds slated for next year. But I thought it was kind of interesting. You guys put out a whole statement asking for input from your own community as to how this money should be spent. Why?
Well, many reasons. One, that's the right thing to do. But secondly, these bond issues, as we kind of call them in the vernacular of the community, often, they do. They face a vote of the people for their approval. So it's obviously advantageous that we have their input. We have done this on a recurring basis about every 10 years. We had a vote in 07, we had a vote in 17, and we do think that the latter part of 25 will be the next one. And this will definitely be a package in excess of $1 billion. And this is really our mechanism for covering our core infrastructure, street resurfacing, bridges, parks, police stations, fire stations. And we got, excellent bond ratings. That's not always to the advantage of the investor, but you're going to get your money back when you invest with Oklahoma City. And our voters obviously also believe and trust in us, and we have passed these typically by wide margins. But right now, we're just kind of in the development phase with a vote next year.
Well, let's talk about, I know it's still a long way till we get to the vote and the actual sale itself, David, but talk about the projects that are, I guess, most necessary in your view right now.
Well, we are 620 square miles. And, to put that into some perspective, you could fit like 10 Bostons inside of Oklahoma City. So we are always, trying to squeeze every last penny on street resurfacing. I think that's where most of our money traditionally goes in these bond issues is resurfacing what ultimately comes out to like nearly 10,000 lane miles within the city limits of Oklahoma City. But through the years, we're making more and more investments in things like public transit, things that maybe we had underinvested in before, things like sidewalks. We'd really stopped building those for half a century. But nonetheless, the vast majority of our money in every one of these bond issues always goes to streets because we're a city that, for better or for worse, is really built around the automobile, like a lot of southwestern United States cities.
I'm curious what you're anticipating in terms of the take-up and the reception to your request for input, young people versus, say, senior citizens, and how involved you think business, the private sector, will be in this.
Oh, yeah, great questions. I guess I wouldn't presuppose how they might respond. But we've got a real nice history in Oklahoma City with a lot of public input And we haven't failed to vote for anything, whether it's one of these bond issues or whether it's a sales tax for our quality of life initiatives. We haven't failed anything since the 1980s. So we have a pretty good track record of engaging with the business community, with people of all ages. And we do work very, very closely with the business community in Oklahoma City. Our Chamber of Commerce and our City Hall have really worked together in partnership on all of these initiatives that have passed over these last 3 decades.
Okay, and of course, Romaine mentioned that this would be for 2025, but I'm curious how you would go about managing people's expectations when it comes to the timeline of these projects. Infrastructure projects, even if it is repaving roads, tend to take longer than a lot of people realize. And especially if it's something bigger, it takes longer and is more disruptive to everyday life. People get invested, but they also get impatient pretty quickly.
Yeah, well, when you're mayor, you're often put in the position of saying, hey, orange is the color of progress, as in the orange cones that are all over the town, I mean, of course, managing those expectations is always the challenge. We will go to the voters with bond issues every 10 years, which means we're going to pace that work out over a decade. And somebody's going to be first, and they're going to feel pretty good about it, and somebody's going to be in year 9, and they're going to be a little more disappointed. But that's just the way it goes. And yeah, I mean, I think the good news is once you create a pipeline like we have in Oklahoma City, at least there's always something happening. There's not dead times when no construction and no investments are being made. Mm-hmm. We have a track record now where we're putting, $200 million of infrastructure out in the community every year. And we have been doing that for a very long time. So I think that helps ameliorate that. And keep in mind, with a bond issue, the advantage is speed. Sometimes on our sales tax initiatives, we'll pay cash for things, and that actually does require more patience. Yeah. At least with bond issues, the whole point of it is you're getting the money up front, and you can at least move a little faster.
I do want to ask you, Mr. Mayor, about the event that you're attending down there, particularly in a political climate where everyone is so focused on whether you're right or left, Republican, Democrat here. These types of events are really an opportunity for you and all of your peers from various cities around the country of all stripes to kind of find out solutions to make your cities better, and not just better, but better for the people who live there, and more importantly, who pay taxes there. What do you want to get out of this event this week?
Well, I think first of all, I would say mayors, and normally I'm thinking of this in the context of the United States, but at an event like this, it's really global. Mayors are, the best, I think, of any political class in the world at working together across partisan lines and really just putting their communities first. And people from America who come to meetings like this might be registered Republicans, might be registered Democrats, but you really can't tell the difference because we're really just trying to work together, learn from each other, borrow best practices. So mayors meet a lot. I'm actually the vice president of the U.S. Conference of Mayors. I'll be the president next year. We have 2 annual meetings, major meetings in the United States. These Bloomberg City Labs happen once a year, and they bring mayors together from the whole world. Mm-hmm. I find these to be really instructive and really helpful for my community because I'm learning a lot, taking a lot home, and mayors as a class, nationally and globally, really work together to affect change. And I think we've made a difference in American politics when you look at things like the bipartisan infrastructure law. We speak with one voice very often, and we've been effective in that.
All right. I really appreciate your joining us and taking the time to speak with us. David Holt is the mayor of Oklahoma City. And I love the way that you framed that question, this idea that and at the end of the day, they're about finding solutions and making sure that taxpayers are rewarded for being able to invest in their city. And that's exactly what they're working on.
Absolutely.
All right. Let's take a look at how markets closed on the day. A bit of a breather here in the recent record-running rally in equities with the S&P and the Dow both backing away from record highs. We did have more banks coming out with results, and for the large part, they were positive. So the KBW Bank Index closing higher. NYMEX crude continues to sink lower. This time, of course, on the latest geopolitical gyrations, Israel may avoid targeting Iran's crude infrastructure. But on the other hand, Romaine, you've got this concern that there's an oversupply in 2025 of oil supply.
Yeah, and that's one reason why you've seen that price kind of pinned in that area here. I mean, you're waiting for clarity, of course, of what's going on in the Middle East and clarity on the supply side as well. Meanwhile, we talk about the earnings picture as it really starts to get into swing this week. We had quite a few earnings across the wire after the bell. And in fact, the biggest gainer in after hours trading among all the large cap stocks, it's a trucking company. J.B. Hunt up about 8%. This after beating on several key metrics, including on EPS as well as revenue. And more importantly, this idea, as Lee Klaskow was talking about, this idea that a lot of those capacity issues that they were dealing with earlier this year, that might, and pricing, that might have actually been resolved.
Yeah, intermodal in particular doing very well. And Omnicom, that's an advertising firm, isn't it?
Advertising firm, of course, missing on both the top and bottom line. You see that moving lower here. Interactive brokers, though, that's your biggest decliner here in after hours trading. A big miss there here and some concerns here about the lack of net interest margin growth. UAL also a nice little beat here, but not much pop in the stock. We'll be back in a moment. This is Bloomberg.
Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is James Patterson, the best-selling 77-year-old author. He is launching a paid multimedia offering on Substack, according to the Wall Street Journal. He wants to be able to share his opinion, which I guess he can't do in his millions of books that he sells. And he's found that this is the best way to do it. Of course, it's a subscription revenue model.
Oh, well, that's good. So for those of us who don't want to subscribe, we don't have to hear them.
That's right.
All right. Well, I'm keeping an eye on Uber CEO Dara Khosrowshahi. He gave an interview with the Financial Times, and one of the part, I mean, it was a pretty wide-ranging interview, but one part that really jumped out at me, he actually talked about his relationship with Tesla and Elon Musk. He talked about the idea that, yeah, they are competing, and that's never easy with a person like Musk, but he's actually opening to partnering with Tesla, specifically, obviously, when it comes to automated driving and this sort of maybe future of robo-taxis.
You know, it's funny that he says that given the stock market reaction Uber got when the robo-taxi unveiling event had very little details and therefore very little for investors to get excited about.
Yeah.
And analysts were calling this like about the best case scenario for Uber and Lyft.
I guess, but I mean, Dara's been pretty clear. I mean, look, he thinks that there is a future for fully self-driving, autonomous kind of taxi cabs, if you will, but it's not here now. He thinks it's going to be a much longer road to get there. And,
yeah, that's fair.
And I think that's where they differ. Obviously, Musk thinks that, you know, he can do this like by next week.
Yeah. Well,
Dara's basically saying, give it a few years.
That's very on brand for both of them, right? All right, third on the docket is Tom Brady. NFL owners have just approved the former quarterback's bid for part ownership of the Las Vegas Raiders. Tom and his partner, Tom Wagner, who's the co-founder of Knight Capital Management, will get a 10% stake of the team. But because Tom Brady's a broadcaster, he
I was a little confused
all these
by
restrictions
this.
placed on him. He can't attend in-person or online production meetings. He can't have access to team facilities, places, or coaches. He also can't criticize officials or other clubs.
Like on camera? Like
on camera, on air.
So how are you going to be an NFL analyst to do that?
Well, then he'll just talk about, like, you know, what I remember about this guy, or if I were in his shoes, you know, he'll just tell personal stories, I guess.
Okay.
He's not reporting.
Okay, I don't know if I like that. I'm kind of over this guy. I mean, I know you love him. I know he's popular.
I don't just love him.
Okay, yeah. I mean, you and like 5 other people. Okay, but you know, but it gets to this idea though too. Is like how is he going to sort of straddle these two worlds here, being basically a co-owner of a team, a small owner, but still a co-owner, and then at the same time be in the booth talking about the team or the team's competitors. Other coaches,
the play on the field.
Other owners.
Yeah.
I don't know. We'll see how this all works out. We've been here before with other celebrities who've had to end up divesting or giving up their media operations in order to do that.
He's going to thread a very fine needle.
All right. We did have a great interview a little bit earlier today, right here on Bloomberg Television, with the former U.S. President Donald Trump. He sat down with our editor-in-chief, John Micklethwaite, where he defended his proposals to increase tariffs on foreign goods. Let's take a listen as to what he had to say earlier today.
Because we're about growth. She's got no growth whatsoever, and we're all about growth. We're going to bring companies back to our country. You look at even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs. I'm not sure that you are. I don't think you are, but I congratulate you on your career. But to me, the most beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm help it. But to me, it's the most beautiful word in the dictionary.
Tariffs, do you think that will bring in the revenues? To use another bipartisan group, Peterson Institute, they say they only bring in $200 billion. That's barely the cost of 2 of your promises.
Yeah, but that's like for what company are you talking about? Okay, look, I brought in with tariffs, and I was just getting started. Then COVID came, and we had because I tell you what, I did a very good job in COVID. Nobody knew what the hell it was. I call it the China virus because I like being a little more accurate. But when that came, we got hundreds of billions of dollars just from China alone, and I hadn't even started yet. But tariffs are two things, if you look at it. Number one is for protection of the companies that we have here and the new companies that will move in, because we're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before, and we're going to protect them when they come in, because we're not going to have somebody undercut them.
And of course, that was the former President Donald Trump speaking with Bloomberg's editor-in-chief John Micklethwait at the Economic Club of Chicago. Joining us now to discuss what we learned is Henrietta Treyz, Veda Partners Managing Director and Director of Economic Policy Research. Henrietta, clearly Trump talking about his favorite word, tariffs, and really pushing back against John Micklethwait's questions about whether that would raise costs for businesses and for consumers ultimately, by saying this is all part of his goal to get companies to move their manufacturing back to the U.S. Is that reasoning flawed, or does that make sense?
The way that he framed it was really aggressive during that incredible interview. I found most notable the fact that he sort of dismissed the idea of a 10% tariff and went straight to the virtues of a 50% tariff. The idea behind, which the former president explained, is to be so punitive that companies have no choice but to manufacture in the United States. It was almost like, forget the cost, forget the impact, it doesn't matter. I'm going to put a tariff on that's so pernicious that the manufacturing industry or whatever you're importing has to come from the United States going forward. So it was very dismissive of the idea that anything was inflationary. And having been with his former U.S. trade representative last week and meeting with, many officials over the last 5 years who have been imposing these tariffs, or 8 years, I guess now, it's clearly that there's a mind meld between his cabinet officials and former President Trump, and the support for tariffs is universal.
Right. And there was not a whole lot of concern about the deficit and that would be increased because of all of this. It was kind of dismissed in the idea that there would be more manufacturing brought home, there would be more businesses developed here in the U.S.
Right. There's no concept of a negative GDP hit, which is interesting because the EU, of course, came out today with a litany of things that they would tariff in the event that Trump increases tariffs on them via Section 232, which is our national security tariff allowance. I think that component where there is not an expectation of a negative feedback loop is really most stark. Again, it's on there being no impact to the consumer as a core belief. And then I think maybe really importantly is that disparity in the revenue, if you want to call it that would be generated by the tariffs. And your editor-in-chief pointed that out pretty succinctly, saying, this is a $200 billion revenue raiser. And when you talk with Trump officials and Trump administration folks, they'll tell you that the potential for tariffs is $1 trillion, which would get you a good bit of the way towards offsetting the cost of extending the 2017 tax cuts. But $200 billion will not move the needle. And that's, I think, much more close to what a reality of these tariffs would look like, unless you get really extreme and go in the 60+% range, which Trump is advocating for.
Well, he's advocated for that and more. And it gets to a broader question here, Henry, and I'm just going to play devil's advocate here for a second, because I know economists can look at this on paper and see that it's not economically sound. Trump was asked specifically about this by Micklethwait, and he pivoted very quickly to this idea that, hey, if you raise these tariffs, if you raise effectively the fence, it forces these companies at some point or another to just start building here. Now, I know it's not that simple, but longer term, is there an argument to be made that these tariffs can facilitate more manufacturing here in the U.S.?
I think that after, 7 years of these tariffs, we've seen a lot of the impact already. The supply chains, as they're able to be moved, talk to the National Association of Manufacturers, which is, what I did practically every day during the Trump administration the first time around. they'll tell you about how it takes 2 or 3 years to set up a new supply chain. And what I hear today, especially from clean energy companies, is that there's just not another source outside of China that they can import their components from. So you'd have to generate an entire new industry. The irony here is that Trump also has in his economic agenda repealing the Inflation Reduction Act clean energy tax credits. So the spurring of economic activity in the clean energy space in particular, and for batteries most notably, is going to be materially hamstrung because you cannot import from China if the tariffs are 60 or 100%.
Yeah.
And you also don't have the industry in the United States. And moreover, you'd be repealing the clean energy tax credits that are trying to create this sector in the United States. So it's really a 1-2 punch.
Yeah, absolutely. And speaking of 1-2 punches, he took a couple of jabs at Micklethwaite there. It's always kind of funny to see your boss take a couple of hits here. You kind of expected it. I thought it was interesting. Towards the end, Micklethwaite tried to sort of get this back on track. And he did ask Trump specifically about the campaign overall. He asked him about the states that he thought were going to be most important for his victory. I think he said Pennsylvania and Michigan before he started rambling about something else here. Is there a sense here that he does have enough of the electoral map on his side where we can realistically expect that he might actually win on November 5th?
Oh, yeah, absolutely. I mean, all the polls, especially in the swing states, are within the margin of error. And in past election cycles, 2020 and 2016, the polls underestimated Trump by about 2 or 3 points across the board, 4 points in a state like Pennsylvania, for example. What my analysis suggests is that we do not have a silent Trump voter this cycle. If you are a Trump supporter, you're very vocal about it. You're responding to pollsters. There's no response bias to speak of. And he is notching almost exactly the same gains and threshold levels with voters today in polls that he secured in 2020, that 47.1%. So I'm skeptical that there's another round of silent Trump voters. We're seeing early data on turnout come in just as we speak. I just published a note to investors, our clients, about what we're seeing from the early returns. It looks like Republican voters are going to the polls early, especially in states where, like Pennsylvania, which are critical, and trying to undercut that message that maybe there's a problem with early state balloting. So there's a lot of movement, but all those swing states are really neck and neck.
No, that's interesting here. That kind of raises the whole question about that whole red mirage that we saw 4 years ago, and whether that, or 8 years ago, excuse me, and whether that repeats itself this time around. Henrietta, got to leave it there. Always a great conversation. Henrietta Treyz over at Veda Partners. A closer look here at the presidential race, and of course that big interview earlier today with John Micklethwaite of Bloomberg News and former President Donald Trump. When we come back, we're going to set you up for the potential market-moving events over the next 24 hours. This is The Close on Bloomberg. All right, pushing ahead to the potential market-moving events over the next 24 hours. We start out bright and early, 7 a.m., Scarlet Fu. What are you going to be doing?
I'm going to look at the mortgage apps, of course. The weekly mortgage apps comes out, and then at 8:30 we get import and export prices, so it's another read on inflation. Well, of course, earnings season also continues, and we start in the morning. We're going to get more bank earnings. The last of the big banks tomorrow morning. Yeah, Morgan Stanley comes out, and of course the big question is how much of a benefit did it get from the equities trading boom that every other bank seems to have seen? We're also going to get some regional blanks, including Citizens Financial, and after the bell, we are going to hear from Discover Financial as well as from Alcoa and a few other names. Join us then for a full breakdown right here on The Close. Balance of Power. It's up next.